Today's recording is going to be problem 10-4B. And so if you'll hold on just a second while I get the screen to share, it'll take me just a second. We're going to be calculating depreciation in this problem using the straight line method and the double declining balance method. And we're going to also do a journal entry to record the sale of an asset. So first of all, to start off, we always need to read the problem carefully. And so what we're going to be is a company that is buying tire retreading equipment. And that equipment is going to be acquired at a cost of $110,000. Remember, it's important to check the dates on all of your problems. In this problem, they are starting or they're buying their asset on September the 1st, which just happens to be this company's beginning fiscal year. So rather than it be a calendar year, their fiscal year is going to be from September the 1st all the way back up to August, end of August. This equipment is going to have a useful life of 4 years, and they've given you the residual value, which is also called the scrap value, which is the value of the asset after it's been fully depreciated. The manager has requested information regarding the effect of alternative methods on the amount of depreciation expense each year. On the basis of the data presented to the manager, the double declining balance method was selected. On September the 6th of year 4, the equipment was sold for $18,000. In requirement number 1, they want you to determine the annual depreciation expense for each of the estimated 4 years, the accumulated depreciation at the end of the year, and the book value at the end of the year. They want you to first do it by the straight line method. So to calculate the depreciation expense in the first year, what we're going to need to know is the cost of the asset. The cost of this asset is $110,000. We're going to subtract from the cost of the asset the residual value or the scrap value, which is $7,500. What that leaves you with is an amount that we call depreciable value. This $102,500 is the total amount that the asset can depreciate over its entire life. To continue with the straight line method, we would take this depreciable value that we found and divide it by the years in the useful life. In this case, the problem tells us it's 4 years. This will give us the annual amount of straight line depreciation. So at the end of the first year, they would have recorded $25,625 as their depreciation expense. The thing about the straight line method is that the depreciation expense per year, if you're depreciating for a full year, will always be the same. So in the second year, the depreciation expense will be $25,625. The same is true for the third and the fourth year. To find the accumulated depreciation, what we're going to do in the first year is take the total amount of the depreciation expense for the first year. Remember, accumulated depreciation is a contra asset account. That means that it's going to have an increase side on the credit side of the account, and the accumulated depreciation at the end of year one is equal to the depreciation expense for year one. In year two, we would continue to add the next year's depreciation expense to the previous balance in the accumulated depreciation to get the next year's accumulated depreciation amount. So in your calculator, since we already have 25,625 in there, I'm going to add to it the depreciation expense for year two, which was 25,625, and that total amount will be 51,250. Each year the depreciation accumulates, so we would add in year three the 25,000, we would add the 25,625 to get the total amount of accumulated depreciation at 76,875. Then we would add to the accumulated depreciation the next year's depreciation expense, to get the total amount of depreciation for this asset, which is 102,500. This total amount of accumulated depreciation is also equal to the depreciable value, which was your cost minus your residual value. To find the book value at the end of each year, you need to know the cost of the asset. The cost of the asset was 110,000. We would subtract out the first year's accumulated depreciation amount, and that will leave you with a book value at the end of year one at 84,375. Again, to find the book value, we would take the cost of the asset in year two, which is still 110,000, is the cost. We would subtract out the accumulated depreciation in year two, which is 51,250. The difference will be your book value at the end of year two, which is 58,750. To find the book value for year three, we're going to take the cost of the asset, and we're going to subtract the accumulated depreciation in year three, which was 76,875. And that will leave you with the book value in year three of 33,125. At the end of year four, we would again take the cost of the asset, 110,000, and we would subtract out the accumulated depreciation in year four, which was 102,500. and that will leave you with the book value at $7,500. Notice this book value is equal to the residual value of $7,500. Also, it's in a different format, but this book value would end up on your balance sheet. It would end up with the assets, the plant assets, right underneath the equipment. You would put the accumulated depreciation, and then out to the side, you would have the book value. The book value will end up on the balance sheet. And of course, your depreciation expense will end up on the income statement in your operating expenses. The next part wants you to calculate the depreciation expense using the double declining balance method. And to do that, what you have to remember is that the book value in the first year is equal to the cost of the asset. The cost of the asset is $110,000. Now, a lot of times students find the double declining balance method to be a little bit more difficult. So I'm going to move and stop sharing this screen with you and move to an Excel spreadsheet that I've prepared so you can see where I'm getting the amounts to put in for the declining balance method. So hold tight. I will stop sharing. It takes me just a second to get that back up. So hold on there. So now you should be seeing the Excel spreadsheet. I'm going to scroll up for just a second so you can see the declining balance method. And you can see also that I've done the straight line method too. However, we need to be talking about the declining balance method since we've already covered the straight line method. What you need to know is the assets cost. The assets cost is $110,000. And in year one, when we calculate the depreciation, which is on line 22 of this spreadsheet, we'll take the cost and we'll multiply that by twice the straight line rate. To get the straight line rate, I'm going to move up the spreadsheet to the line 12, and you can see here that to find the straight line rate, we would take the number 1 and divide it by its useful life. Since this asset had a useful life of 4 years, when we divide 4 into 1, it will give us 25% as the straight line rate. In the declining balance method, we will multiply the straight line rate by 2 to find twice the straight line rate. Since the straight line rate was 25, if we multiply it by 2, it will give us 50% as our straight line rate. This twice the straight line rate is what we use to calculate the depreciation for the declining balance method. So going back to line 22 in the first year, I'm going to take the cost, which was $110,000, and I'm going to multiply that by twice the straight line rate. What that will give me is $55,000. You might notice up here, they show you how I got that, just in case you need to see it again. But $55,000 is the depreciation expense in year one. At the end of the year, we create an adjusting entry that will debit the depreciation expense and credit accumulated depreciation. So at the end of year one, you will notice that in line 18, the accumulated depreciation is $55,000. It's the same as the depreciation expense in year one. So to find the book value of the asset, we will subtract the accumulated depreciation from the cost to get the book value at the end of year one. The book value at the end of year one is then going to be multiplied by twice the straight line rate, which is 50%. So this book value of $55,000 is multiplied by 50%, and that will give you the depreciation expense in the second year, which is $27,500. So in Cengage, they want you to first record the depreciation expense. So for year one, it was $55,000, and in year two, it was $1,500. Before we can determine the depreciation in year three, we have to know what the book value is at the end of year two. So again, we're going to take our cost and we're going to subtract out the accumulated depreciation. That accumulated depreciation consists of $55,000 plus $27,500. The total accumulated depreciation in year two is $82,500. We will subtract the accumulated depreciation from the cost, and that will give us the book value in year two. The book value at the end of year two will be multiplied by twice the straight line rate to get the depreciation expense in year three. So the book value of $27,500 will be multiplied by 50% to get $13,750. This is the depreciation expense in year three that we would first enter in our Cengage problem. Before we can determine year four's depreciation, we have to find the book value in year three. The book value is the cost minus the accumulated depreciation. All three of the depreciation expenses in each one of the 3 years is added together to get the total accumulated depreciation in year three. This accumulated depreciation in year three is subtracted from cost, and that will leave you with the book value of $13,750. And as you remember from the previous problems that we've done on other videos, we cannot continue like we would normally do in the next year, because if we did, we would get too much depreciation in year four. Remember, you should never depreciate below the scrap value. So I've made a notation on my spreadsheet to remind you about that. To find the depreciation in this year, first we would need to know what the accumulated depreciation is up to year three, and it is $96,250. Then we would subtract this accumulated depreciation from the depreciable value. Remember, the depreciable value is your cost minus your scrap value. So the depreciable value was $102,500. We will subtract the accumulated depreciation from that, and that will leave us with the depreciation expense in the last year. The depreciation expense in the last year would be added to the previous accumulated depreciation to get the total accumulated depreciation in year four. the total accumulated depreciation would be subtracted from year 4 to get the book value of $7,500. Remember, your book value in the last year cannot go below the scrap value. The scrap value in this asset was $7,500. So this is how you would calculate the depreciation for this particular problem. So bear with me again. I'm going to go back for just a minute to the Cengage problem, and it'll take me just a minute to do that. So go ahead and look at this worksheet while I'm preparing to do that. It'll take me just a second, so bear with me, class. Just a second. Be patient. It's going to take me just a second. Hang tight. I'm going to get there eventually. So I'm going to stop sharing this for just a second. Hang tight. All right, you should be able to see the declining balance method, and this is Cengage now that we're looking at. The depreciation expense that we figured from our spreadsheet for year 1 was $55,000. The accumulated depreciation was also $55,000. And the book value in year 1, let me recalculate that, would have been 110,000 minus 55,000, which would have given you 55,000 again, because our straight line rate was exactly half. All right, in year 2, our depreciation expense was 27,500. The accumulated depreciation was 82,500. And then I'll figure the book value, which was 110,000. That's your cost, minus 82,500. And that'll give you 27,500 book value. And the depreciation expense in the 3rd year was 13,750. The accumulated depreciation was 96,250. And the book value was 110,000 minus the accumulated depreciation of 96,250. Let me try that again. It was 110,000 minus 96,250, which left you with 13,750. And in the last year, the depreciation expense that we had to determine was 6250. The accumulated depreciation was 102,500. And the scrap value or the book value would be equal to the scrap value, and the scrap value was 7,500. All right. The next part of this problem, they want you to journalize the entry to record the sale, and you are assuming that you're using the declining balance method. So let's go back to the original problem and let's read it again. Remember that the fiscal year begins on September the 1st. And it tells us that in this problem that on September the 6th of year 4, the equipment was sold for $18,000. That's an important piece of information there. First of all, they didn't fully depreciate their asset. What they did, they depreciated for 3 years. So I want you to listen to me carefully, and then I'll flip back to my Excel spreadsheet again so you can see this in another format. When you sell an asset, you're going to be receiving some cash from the sale. The sale was sold for $18,000 in cash. There was no mention of a liability here. So our cash, which is an asset, will be debited for the selling price. The selling price was $18,000. The next debit that we would record in this journal entry is a debit to the accumulated depreciation. When we debit accumulated depreciation on the equipment, we're reducing the contra asset account and we're taking it off of our books. Remember, we sold the asset at the beginning of year 4. So what we want to do, class, is we want to look at the depreciation that we had recorded up to year 4, which was 96,250. We will debit this 96,000, let me put it in there right, 250, because we are reducing the accumulated depreciation to 0. We're taking it off, in other words, of our books because we've sold the asset. We no longer have the accumulated depreciation that goes with that. Since we're selling the asset, we're going to credit the asset account called equipment for the cost of the asset. The cost of the asset, if you'll remember, was $110,000. Now, when we sell an asset, it's important to know what the book value of the asset was at the date of sale. In this case, the book value of the asset at the end of year 3 was $13,750. You will compare this book value, what we bought the books, to what we sold it for $18,000. Do you see that the book value in year 3 is less than what you sold it for? So what we're saying here is that since the value on our books was less than what we received in cash, that we had a gain on the sale for the difference. So I'm going to look at my calculator and I'm going to put in the cash amount that I sold the asset for, which was $18,000, and I'm going to subtract from that the book value of this asset. The book value for the declining balance method in year 3 was $13,750. When I subtract that from what I sold it for, it gives me a gain of $42.50. So we would record this as a gain on the sale of equipment. Gains are increased on the credit side because they are considered to be other income, and that other income would be reported on the income statement. The gain on the sale of equipment would go on the multi-step income statement in the other items category, and it would be credited in your ledger because we are adding to this type of income or this type of gain. A gain is similar to revenue in that it increases on the credit side. So my journal entry is in balance now. We have 2 debits and we have 2 credits, and they're in balance. In the next part of this problem, they're asking you to journalize the entry to record the sale, assuming that the equipment sold $10,500 instead of $18,000. This is a what if analysis. So what if we sold the asset for $10,500? We would have received cash, so my cash would be debited $10,500. I would have to get rid of my accumulated depreciation for the equipment for the total amount at the end of year 3, which was $96,250. I would credit my equipment account for its cost, which was still $110,000 that was given. And then I would compare the $10,500 to my book value at the end of year 3. Notice your book value at the end of year 3 is more than what you received in cash. So therefore, there is a loss on the sale of this asset. And so I'm going to see if this will allow me to do this. The loss on the sale of the asset would be debited. To calculate the amount, we would take the amount that it was sold for this time, which was $10,500, subtract from it the book value. The book value was $13,750. And what that will leave you with is a loss of $32.50. Losses are treated like expenses they have normal debit balances. They will increase on the debit side. 32.50. Okay, so it doesn't like what I have here. And the reason is, first of all, the accumulated depreciation on the equipment, I've written in the wrong thing there. The accumulated depreciation was 96,250. That was from year 3, 96,250. So I just wrote that down wrong. And it doesn't like the order that I have these in, because technically we should always put our debits first. So the loss on the sale of equipment would go here instead of equipment. And the loss on the sale of equipment was calculated at 32.50. And then the credit would have been to the equipment account itself. And the equipment account would have gone in at the cost of the equipment, which would have been $110,000 was the cost of the equipment. Now it's showing as being correct. I know this is saying incorrect, but it's correct now. The equipment would be credited for $110,000. You must put your debits first and then indent and put your credits down in the journal. So I'm going to stop sharing this for just a minute, and I'm going to go back to our spreadsheet again, and I'll show you where I've made an explanation about how you would handle these two transactions. So bear with me again. I will stop sharing the screen, and we're going to go back. And hold on just a second because I'm not quite there yet. And now you should be seeing the Excel spreadsheet again. At the bottom of this spreadsheet, I put a note about the journal entries. If the selling price is more than the book value, you will record a gain on the sale. The gain on the sale of the asset in T account form will increase on the credit side because it's treated like revenue. The gain on the sale of asset also is an income statement account. Gains will increase on the credit side, and the losses will increase on the debit side. Both the gains and losses are found on the income statement in other revenue and expense category. So if the selling price is less than the book value, you would record a loss on the sale, and that loss would be represented in a ledger account, and this T account represents our ledger account. Losses would increase on the debit side. That should be a plus there. Let's see if I can change that. They're going to increase on the debit side. Here we go. Losses increase on the left side of the account, the debit side, and they will decrease, of course, on the right side. Gains are opposite of losses. They will increase on the credit side and decrease on the debit side. I hope this has helped you a little bit with this particular problem. I'm going to stop sharing and I'm going to stop recording.